Linda Castellano spent 31 years teaching fourth graders in Clark County, Nevada. 31 years of alphabet posters and parent-teacher conferences where she smiled even when the parents did not deserve a smile. She retired in January of 2024 at 65 with a modest pension, a paid-off townhome in Henderson, and a Social Security benefit the government told her would arrive at $1,640 per month. She had done everything right, contributed to her 403b, avoided credit card debt, sat through those terrible district-sponsored retirement seminars where a man in a cheap suit told her to maximize her golden years. Linda waited for that first deposit the way you wait for a verdict. Budget on a yellow legal pad. Mortgage, gone. Utilities, $210. Groceries, $400. Her math worked. She was going to be fine. Then the direct deposit hit and Linda Castellano was not fine. The number was not 1,640, it was 1,112. $528 had vanished before she touched it. No warning, no phone call. Just a smaller number than the one she was promised, sitting on her bank statement like a lie. Linda drove to the Social Security office in Las Vegas. She waited 3 hours. A clerk behind plexiglass told her that her Medicare Part B premium was $527.50 per month, not the standard $202.90. Linda said there must be a mistake. The clerk said the SSA had reviewed Linda's 2022 tax return, the most recent on file when her 2024 premiums were calculated, and that return showed a modified adjusted gross income of $193,000. Linda said that was insane. She was a school teacher. She had never earned that in a single year. But the clerk was right. In 2022, Linda made $78,000 from her 403 Beckett into a Roth IRA. That conversion was a taxable event. Every dollar showed up as ordinary income on her 2022 Form 1040. Add her $61,000 salary, $12,000 in early vested pension contributions, and a capital gain from selling a rental condo her mother left her, and Linda's MAGI for 2022 landed at $193,000. That one-time spike triggered the Income-Related Monthly Adjustment Amount, IRMAA. I call it the ceiling surcharge trap, and it was eating Linda alive. Here's the part that should make you furious. Linda was no longer earning $193,000. In 2024, her actual income was Social Security plus a small pension, maybe $52,000 total. She was clipping coupons and shopping at Winco, but the government was charging her Medicare premiums as if she were a hedge fund manager because of a tax return filed 2 years earlier. The system was using a rear-view mirror to price her health care, and that mirror showed a road she was no longer on. $324.60 every month in Part B surcharges alone, plus $60.40 for Part D, $385 a month. $4,620 a year taken directly from her benefit before she could spend a dime on food or medication, and nobody at the Social Security office told her there was a way to fight it. Nobody handed her the document. They let her walk out with a smaller check and that look I have seen on too many retirees, the look that says I did everything right and the system still took my money. If that story makes your blood pressure spike, you are in the right place. And if you are watching this and thinking that could never happen to you, I need you to understand something. It is happening right now in 2026 to millions of retirees across America. The IRMAA income thresholds for 2026 start at just $109,000 for a single filer. $109,000. That is not wealthy. That is a retired teacher who did a Roth conversion. That is a retired firefighter who cashed out a deferred comp plan. That is a widow who sold her husband's truck and his fishing boat in the same year she collected his life insurance. The threshold for married couples filing jointly is $218,000. And if you think that sounds like a lot of money, go add up your Social Security, your pension, your required minimum, distributions, your capital gains on that mutual fund you forgot about, and the tax-exempt interest on those municipal bonds your broker sold you. You might be closer to that cliff than you realize. And it is a cliff, not a slope. $1 over the line and the full surcharge for that tier hits you like a freight train. This is the episode where I show you the document the government does not want you to find. The single federal form that can wipe out your IRMAA surcharge, restore your Social Security check to its full amount, and put thousands of dollars back into your pocket this year. I am going to walk you through every line of it. I am going to show you exactly who qualifies, exactly what to write, and exactly where to send it. But first, smash that like button right now. I am not asking because I enjoy the dopamine hit. I am asking because the 2026 algorithm buries financial truth for seniors under 30 layers of clickbait about celebrity diets and crypto scams. Every like you leave on this video is a vote that tells the algorithm this information matters more than a Kardashian workout routine. Hit it now and let us get to work. The suits want me to tell you this is not financial advice. Fine. It is not financial advice. It is a survival guide for a system that charges you luxury healthcare prices based on income you no longer earn. Consult a credentialed professional if you still trust the same industry that told Linda Castellano a Roth conversion would simplify her retirement. Now let me build the case. The mechanism draining Linda's check and possibly yours is the IRMAA 2-year look-back. Here is how it works. When you enroll in Medicare Part B and Part D, the SSA does not look at your current income. It looks backward. It pulls your modified adjusted gross income from the federal tax return filed 2 years prior. For 2026, the SSA is using your 2024 tax return, not your 2025 income, not what you are living on today, your 2024 return. If that return shows MAGI above 109,000 as a single filer or above 218,000 as a joint filer, the SSA slams you into one of 5 surcharge tiers, and each tier operates like a cliff. No graduated phase-in, $1 over the line, and you pay the full surcharge for that entire tier. Let me show you actual dollars. The standard Part B premium in 2026 is $202.90 per month. But if your 2024 MAGI was between 109,001 and 137,000 Tier 1, your premium jumps to $284.10, $81.20 in surcharges. Between 137,000 and 1 in 171,000 Tier 2, your premium is $405.80. Across 171,000 up to 205,000 Tier 3, $527.50. That is where Linda landed. Above 205,000 up to 500,000 Tier 4 charges, $649.30. Above 500,000, the top tier $689.90 every month just for Part B. Part D, IRMAA, adds another $14.50 to $91 per month on top of your drug plan. Now here is the critical math that the government does not advertise. These surcharges are deducted directly from your Social Security check, not billed to you separately, not invoiced quarterly so you can plan for it, taken from your benefit before you ever see it. So when a retiree like Linda looks at her bank account and sees a Social Security deposit that is hundreds of dollars less than what she was told she would receive, she is not looking at a processing error. She is looking at the IRMAA machine doing exactly what it was designed to do, extracting premium income from seniors based on financial decisions they made years ago, in many cases before they even enrolled in Medicare. If you have ever been blindsided by a Medicare premium that was 3 or 4 times higher than what your neighbor pays, drop a comment right now. Tell me your story. I want to know if it was a Roth conversion, a home sale, a pension lump sum, or something else entirely that pushed you over the cliff. Your field reports help other retirees in this community recognize the trap before they step in it. Let me take you through the rule of 3 because IRMAA does not care what state you live in. But the financial devastation it causes plays out differently depending on where you retired. Take Florida first. Florida has no state income tax. That is the whole reason half the retirees in America move there. But here is what they did not think about. A retired couple in Naples sells their vacation condo in 2024 for a $400,000 gain above their exclusion. They have no Florida income tax to worry about, but that gain shows up on their federal return. Their 2024 MAGI spikes to $360,000. In 2026, both spouses get hit with Tier 3 IRMAA surcharges. That is $324.60 per person per month in Part B surcharges alone. For 2 people, that is $649.20 per month or $7,790.40 per year ripped from their combined Social Security benefits. They moved to Florida to save on taxes, and the federal government found a different pocket to pick. Now look at Ohio. Ohio taxes retirement income with a modest credit and exemption. A retired auto worker in Dayton takes a lump sum pension distribution of $120,000 in 2024 because his advisor told him to get ahead of the tax brackets. His regular income was $55,000. That lump sum pushes his MAGI to $175,000, Tier 3. Part B, premium $527.50 per month. Part D, surcharge $60.40. Total monthly surcharge $385. He already paid Ohio state tax on that distribution. Now the federal government charges him healthcare premiums as if he will earn that money every year. He will not. It was one check, one decision, $4,620 in 2026 alone. California is the triple threat. A retired state employee in Sacramento who took a CalPERS lump sum option and sold a rental property in the same year can spike past $205,000 and land in Tier 4. Part B, premium $649.30 per month. Part D surcharge $76, combined monthly surcharge above the standard rate $522.40. Over 12 months, $6,268.80 in IRMAA surcharges on top of California's 13.3% top state income tax rate. The same retiree is taxed by California, surcharged by the federal government on Medicare, and still paying property tax on whatever real estate they did not sell. 3 levels of government extracting revenue from one retirement decision in one calendar year. This is where the government bets against you. They bet that you will look at your shrunken Social Security check, assume it is correct, and never ask questions. They bet that you will pay $527.50 a month for Medicare when you should be paying $202.90. And you will blame yourself for not saving enough instead of blaming the system for using outdated income data to calculate your premium. They bet that you will never find the document. That is the bet. And for millions of retirees, the government wins that bet every single year, but not for you. Not after today. The document is called Form SSA-44. Its full title is Medicare Income-Related Monthly Adjustment Amount Life-Changing Event. It is 6 pages long. It is available for free on the Social Security Administration website, and it is the most powerful piece of financial paperwork that most retirees have never heard of. Here is what it does. Form SSA-4-4 allows you to request that the Social Security Administration throw out the old tax return it used to calculate your IRMAA and replace it with a more recent year that reflects your actual current income. You are not asking for a favor. You are not begging for mercy. You are invoking a codified federal process that the SSA is legally obligated to consider, but you have to qualify. The form lists 8 categories of life-changing events. If you experienced any one of them and your income dropped as a result, you are eligible to file. Listen carefully. The 8 qualifying events are marriage, divorce or annulment, death of a spouse, work stoppage or work reduction, loss of income-producing property due to circumstances beyond your control, loss of pension income, employer settlement payment or closure, and a catch-all category for any other event that caused a significant income reduction. The SSA evaluates that 8th category on a case-by-case basis. Now let me be absolutely precise about what qualifies and what does not, because this is where retirees make mistakes that cost them thousands. If you retired, that is work stoppage, you qualify. If you reduced your hours from full-time to part-time and your income dropped, that is work reduction, you qualify. If your spouse died and the household lost their income, you qualify. If you got divorced and your filing status changed from married filing jointly to single, you qualify. But here's the line that trips people up. If you voluntarily sold a home or investment property for a profit, that sale by itself is not a qualifying life-changing event. The SSA does not consider a voluntary capital gain a life-changing event. The Greenbush Financial Group publishes explicit guidance on this point. So if the only thing that spiked your 2024 income was selling your lake house, you cannot use SSA 4-4 to fix it unless you also experienced one of the other qualifying events in the same period. This matters because the scenario I described with Linda Castellano involved 2 things happening in the same year. She did a Roth conversion and she sold a rental condo. Neither of those standing alone would qualify her for SSA 4-4 relief, but she also retired. Retirement is work stoppage. That is the qualifying event. The Roth conversion and the condo sale explain why her income spiked, but the retirement is what opens the door to the form. This distinction is critical. Your qualifying event is the reason your income dropped. The spike is just the historical number the SSA is using against you. Now, I need you to go to retireeshieldreport.com. That is retireeshieldreport.com. I built that resource specifically for situations like this. Inside, you will find a breakdown of IRMAA tier thresholds updated for 2026, a checklist of the 8 qualifying life-changing events with specific documentation requirements for each one, and a walkthrough of the SSA 4-4 filing process that goes beyond what I can cover in this video. The government's own instructions on the form are written in the kind of bureaucratic language designed to make you give up on page 2. The Shield report translates it into plain language. Go there now, bookmark it, and come back to finish this video. The link is in the description. Let me now walk you through the 2 scenarios side by side, because this is where the math becomes a weapon you can either use or be destroyed by. Scenario A. John Morrison, 66, retired teacher, single filer. In 2024, John's last year of full employment, he earned $62,000 in salary. His financial advisor recommended converting $80,000 from his traditional 403B into a Roth IRA to take advantage of what were then the current tax brackets. John also received a $23,000 distribution from a deferred compensation plan, had a small pension payout and some investment income, and John's 2024 MAGI landed at $191,000. John is now retired in 2026. His actual income is Social Security plus a small pension totaling roughly $48,000, but the SSA pulled his 2024 tax return $191,000. Tier 3. His Part B premium is $527.50 per month. His Part D surcharge is $60.40. The SSA deducts $587.90 from his Social Security benefit every month for Medicare premiums. His gross Social Security benefit was $1,720. After the IRMAA inflated deduction, he receives $1,132.10. On an income of $48,000, John is paying healthcare premiums designed for someone earning 4 times that amount. Over 12 months, John loses $7,054.80 to Medicare premiums, of which $4,620 is pure IRMAA surcharge that would not apply if the SSA used his current income. Scenario B, John files Form SSA-44. He checks the box for work stoppage. He attaches a letter from his former school district confirming his retirement date. He writes in his estimated 2025 MAGI of $48,000. He signs the form, attaches a copy of his 2025 tax return showing the lower income, and submits it to his local Social Security office. The SSA reviews the form. John's $48,000 MAGI is below the $109,000 IRMAA threshold. His Part B premium drops to the standard $202.90. His Part D surcharge disappears entirely. His monthly Social Security deduction drops from $587.90 to $202.90. His take-home Social Security check increases by $385 every single month. That is $4,620 per year returned to his bank account from one form. 6 pages. A 20-minute task that pays him back at a rate of $231 per hour of effort. No attorney required, no accountant bill, just a retiree who knew the document existed. If you are sitting there right now calculating your own IRMAA exposure, save this video to your private library immediately. Do it right now. Hit the save button or add it to your favorites. This is your reference manual. When the SSA sends that initial determination letter telling you your premiums are higher than standard, you are going to come back to this video, pause it on the steps I am about to give you, and follow them line by line. This is not entertainment. This is a survival document. Here are the 7 steps, and I want you to write these down or screenshot them because the difference between following them and ignoring them is $4,000 or more per year. Step 1. Get your IRMAA determination letter. The SSA sends this letter before the start of each calendar year or when you first enroll in Medicare. The letter tells you your premium amount and the tax year used to calculate it. Do not throw this letter away. It is your evidence that the surcharge has been applied, and it is the starting point for your appeal. Step 2. Identify your qualifying life-changing event. Go through the list of 8 events. Retirement and work reduction are by far the most common for retirees hitting IRMAA for the first time. If you retired or significantly reduced your work hours and your income dropped as a result, you have your event. Write down the exact month and year it occurred. Step 3. Gather your documentation. For work stoppage, you need a letter from your former employer confirming your retirement date and the cessation of employment income. For death of a spouse, you need a death certificate. For divorce, you need the decree. For loss of pension, you need documentation from the pension administrator. The form itself lists the required evidence for each category. Do not submit the form without the evidence. An incomplete submission delays everything. Step 4. Download Form SSA 4.4 from SSA.gov. The direct URL is ssa.gov/forms/ssa-44.pdf. Print it. The current version is dated December 2025. It has 5 steps within the form itself. Do not confuse the form's internal steps with the 7 steps I am giving you here. Step 5. Complete the form. In Step 1 of the form, check the box for your qualifying event and enter the date. In Step 2, enter the tax year in which your income already decreased due to the event, your adjusted gross income for that year, your tax-exempt interest income, and your filing status. If you already have your 2025 tax return completed, use those numbers and attach a copy. If you do not yet have your 2025 return, you can use an estimate. The form explicitly allows estimated income figures. In Step 3 of the form, estimate your MAGI for the following tax year. In Step 4, attach your evidence. In Step 5, sign the form and include your phone number and mailing address. Step 6, submit the form. You can mail it to your local Social Security office, fax it, bring it in person, or in many cases, submit it online through your My Social Security account at ssa.gov. If you submit in person, bring originals of your supporting documents. The SSA will copy them and return the originals. Do not hand over original documents without getting them back. Step 7. Follow-up. Processing typically takes a few weeks. If your appeal is approved, the adjusted premium applies to future months. Any excess premiums you already paid will be reimbursed, typically through a credit to your Social Security benefit or a mailed check. Do not assume silence means approval. Call the SSA at 1-800-772-1213 if you have not received a response within 30 days. That is the protocol. 7 steps, 1 form, thousands of dollars recovered. Now share this video. Think about the person in your life who just retired. The neighbor who mentioned their Social Security check was smaller than expected. The sibling who took a lump sum pension payout last year and has no idea what is about to hit them. Send this video to one retiree you care about, not tomorrow, today. One conversation now saves them $4,600 or more later. Text them the link. Post it in your church group chat. Just make sure one more person learns that Form SSA-44 exists before the government takes another month of surcharges from their check. Let me address the objection I hear from the skeptics. Some people say, well, the IRMAA lookback adjusts every year. If your income goes down in 2025, your 2027 premiums will automatically drop when the SSA pulls your 2025 tax return. That is technically true, but let me show you the cost of waiting for the system to fix itself. If John does nothing in 2026 and waits for the natural look back to adjust in 2027, he loses $4,620 in surcharges during 2026. That money is gone. The SSA will not retroactively refund surcharges from a year where you failed to file the appeal. You pay the inflated premium for every month you delay. If John files SSA 44 inches January 2026 and it is processed by March, he recovers the surcharges from January and February as a refund and pays the standard rate for the remaining 10 months. His savings for the year are still over $3,800 compared to doing nothing. The cost of waiting is not zero. It is $385 for every month you sit on your hands. Subscribe to this channel right now and hit the notification bell. I release these investigations every week and the algorithm does not reliably show them to you unless you are subscribed with notifications on. Join the archive before the system flips the kill switch on your purchasing power every episode. In this series is designed to put money back in your pocket by showing you the forms, the codes, and the deadlines that the financial industry has zero incentive to teach you. You are not their client. You are their revenue. I want to go deeper on one thing because I see this mistake constantly: the Roth conversion trap. A Roth conversion is one of the most powerful long-term tax strategies available. You pay tax now, move the money into a Roth where it grows tax-free, and you never pay required minimum distributions on it. But here is what your advisor may not have told you. Every dollar you convert shows up as ordinary income on your federal return in the year of conversion. If you are 63 and convert $80,000, that gets added to your AGI. Push your MAGI above $109,000 as a single filer and you will pay IRMAA surcharges 2 years later when you enroll in Medicare. Your advisor gets paid on the conversion. You get the IRMAA bill 2 years later. And the sick irony is that the IRMAA surcharge is not technically a tax. It is a premium adjustment. It does not show up in the tax projections your advisor ran. They showed you the income tax savings. They did not show you the $4,600 Medicare surcharge eating into those savings 2 years down the road. This is why you need SSA 4-4. It is the pressure relief valve. If you do a Roth conversion at 63 while working, then retire at 65, file SSA 4-4 claiming work stoppage. Provide your estimated current year income showing you are below the threshold. The SSA recalculates, the surcharge disappears. You keep the Roth conversion and dodge the IRMAA. That is how the informed play this game. One more resource before I send you off armed and dangerous. Go to retireeshieldreport.com one more time. I have added a new section specifically on IRMAA avoidance strategies for 2026 and 2027 that covers Roth conversion sequencing, income timing around the look-back window, and the interaction between the new senior bonus standard deduction under the One Big Beautiful Bill Act and your IRMAA threshold positioning. The One Big Beautiful Bill made the Tax Cuts and Jobs Act rates permanent and added a $6,000 senior bonus deduction for filers 65 and older. That extra deduction reduces your taxable income, but here's the catch that nobody is talking about. The IRMAA calculation uses modified adjusted gross income, which is your adjusted gross income plus tax-exempt interest. The standard deduction, including the senior bonus, reduces your taxable income below AGI. It does not reduce your AGI itself, so the senior bonus deduction helps your income tax bill, but does absolutely nothing for your IRMAA exposure. Your MAGI stays exactly the same whether you claim the senior deduction or not. The system gives you a tax break with one hand and charges you a healthcare surcharge with the other, and the two hands do not talk to each other. That breakdown is at retireeshieldreport.com. The link is in the description and pinned in the comments. Here's the final warning. The Social Security Administration will never call you to tell you that you qualify for an IRMAA reduction. They will never mail you Form SSA-44 with a helpful note. They will never proactively review your account and adjust your premium. The system is designed to charge you first and make you fight for a correction. If you do nothing, you pay the surcharge. If you file the form, you get your money back. The government structured this so that ignorance is the most profitable outcome for the Treasury. Every retiree who does not know about SSA-44 overpays. Every month without a filing is a month of surcharges the government keeps. That is not a conspiracy theory. That is the published administrative procedure of the Social Security Administration printed on their own website, available to anyone who knows where to look. Now you know where to look. If this is the first video of mine you have watched, welcome to the archive. This is where we decode the financial machinery quietly extracting wealth from American retirees. Every episode targets a specific trap, a specific form, a specific code section, and gives you the exact countermeasure. I do not sell insurance. I do not manage portfolios. I do not get paid when you roll over your IRA. I get paid when you smash the subscribe button and tell the algorithm this content matters. Subscribe, bell on. Come back next week. Because before you try to use that extra Social Security cash to pay off your mortgage or stuff it into a savings account, the next video reveals the HOA foreclosure trap. That is the mechanism that allows a $300 homeowners association debt to trigger a lien, a forced auction, and the seizure of your fully paid off home. I am going to show you the state-by-state rules, the redemption windows, and the one recording you need to file at your county clerk's office before the HOA board meets again. You do not want to miss that one. I will see you there.